All right. So Hunter and Isabel, you're doing chapter 8. And chapter 8, we've done part of this before. And so it should be just a little bit of a review. So I'm going to share my screen with you guys. And then we're going to go over um, the PowerPoint. So remember, notes payables are notes that we're going to have to pay back. So we're going to use notes payables to make sure that we have enough money for payroll. We can use them to make sure that we can use them to buy items that we need for, equipment or things like that. So we're going to use those to borrow money. And so most of those, like I said, they're going to be, we have what we're going to borrow money, and that's called debt financing. So we're going to sign that promissory note. And so when you guys go to college and you borrow money, you take out a student loan, you're going to have to sign a promissory note. And that just says that I know that I'm signing on this note, and this is how much interest I'm going to have to pay, and this is how long, and I'm going to pay it back. So the promissory note has the date right up here, the original amount of the note, which is right here. This one's $25,000. They have the maturity date down here. That's the date that it has to be paid by. And then it has the interest rate right here. That's how much interest we're going to pay. So most promissory notes like this one are only for 180 days or for 90 days or 60 days or 30 days. So they're less than a year, okay? We're going to use those because we're going to use them. They're going to be called current liabilities. So anything within a year, we call those current liabilities. So if this was to be like 2 years or 600 or 400 days, that would be more than a year. Those would not be considered current. Those would be considered long term. All right. So on the example, so we just signed March 8th, we signed for a 180-day 8% note for $25,000. So this information, the 180-day 8%, is going to come in when we pay for it. So right now it's just extra information. What we need to know is that it's a note and we got $25,000 for it. So when it's recorded, you use the date, notes payable. We received money, so it's a receipt. It's going to go under general credit because it's a note. And then cash debit because we're getting cash for it. Now, calculating the maturity date, you guys have to remember, do the knuckles thing for the shortcut and count how many days. So remember that you do include March 8th. So that's why it's 23 days on that first month. Because you have 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, and 23. So it'll give you 23 days. So then you subtract it. That leaves 157. There's 30 days in April, 31 days in May, 30 days in June. So you just keep going as you go. You keep subtracting. 31 days in July. That leaves us 35, 31 days in August. That leaves us 4 more days. And so it's going to be due on September 4th. Okay, so this is how we're going to calculate that maturity date on those. And I know we've already done this before. So it's kind of a review. So calculating interest. There's my $25,000. Interest rate 8%. This time, before we were only using 360. This is the difference. Now we're using 365. So we've done this using 360. Now we're going to use it doing it using 365. So our interest for that portion of the year, that 180 days, is $986.30 that we're going to have to pay. That's our interest expense. So when we pay it, so here's our interest expense. So when we pay it, it looks like this. So on September 4th, we paid for the maturity value of the March 8th note. Oh, open here. Sorry. Sorry. I just had to answer a question. So we have our note. Now it's going into the general debit for $25,000 because we're going to have to pay the principal. Plus we have to pay that interest. So we have our interest expense, right? And expenses are always debits. And so when we end up paying them, we're going to end up paying them $25,986.30 in order to pay the note off. Okay. So that's how we're going to remember, like I said, the 8% and the 180 days don't come into play until we go to pay for it. So any note that has interest is called an interest-bearing note. So if there's, so then they have this as it's an alternative type of note that proceeds that are less than the maturity value of the note. So a note that deducts interest from the face value is called a non-interest-bearing note. So on this one, okay. So on this one, they purchased $36,096.51 of merchandise, signed a 60-day non-interest-bearing note for $36,500. So this is how they figured out what the implied interest is. So they took the interest. So they subtracted these two to get the amount of interest they're not paying, right? They divided that by how much we used, and then we divided it by the 6365. So it comes out to 6.8% interest that we basically had paid because they didn't tell us how much real interest was applied. A line of credit is just it's just that from our bank. So we contacted our bank and said, hey, we need to get in a line of credit. They're probably going to use it to pay for payroll. And if we draw on a line of credit, there's an account just called line of credit. And so obviously it's a payable, okay, because we're going to have to pay it back. So it's a credit, and then that money is going to go into our cash account. So when you pay that line of credit, there's always interest attached to it. So you have to figure out the interest. So up here, remember, it was a line of credit. And then down here, paid cash for the principal. And notice they already give us the interest. So it is interest, considered interest expense. All right. Adjusting and adjusting and reversing entries. We have those, what they call cash paid for an expense in one physical period that is not used until a later period are those prepaid expenses. So you have some of those examples. So it says the following example shows the initial recording as an expense, supplies expense, debit, and cash or accounts payable credit. So here's one of our regular adjusting entries, right? And then down here, they show it. The debit balance of 7 is in supplies, represents the supplies on hand. Okay, so they show it on here how much we have in our supplies. But then when we start, so we start the beginning of the year with that amount. So we have less. So we're going to take that amount out. And so it says the rule for when to reverse. If an adjusting entry creates a balance in an asset or a liability account, the adjusting entry has to be reversed. So on this one, it created a balance in our adjusted account. And so we had to get that, we had to reverse it. So same thing here with prepaid advertising and advertising expense. We're prepaying because it's a contract. And then obviously once it's closed, then you might have to do a reversing entry. So they give you here an example of comparison of prepaid expenses. So they give you, what it looks like with the adjusting entry, what it looks like with the closing entry, and then the reversing entry here. And then what it looks like with just the adjusting entry and the closing entry. So it's not necessarily required, but they could possibly do that. So what I want you to do, warranty expenses. So it says that has a 60-day 8% notes payable, $900, dated December 6th. So you have, so they owe 25 days worth of interest. And so we're not paying them yet because we don't pay them the interest until the full 60 days is up. But we do have to realize that interest in our current year. So they calculated the interest. It came out to $49.32 for those last couple of days of December. And we have an adjusting entry for it. Okay. And then we reverse that entry at the beginning of January because all of that interest is going to come out when we actually pay it. When we actually pay it at the end of those 60 days. So, and then this is showing it at the end of those 60 days, all being paid off. Okay. So there's that 49 that we ended up taking out and we're ending up paying it. If there is a warranty, so it says Jackson Sports sold 850 carts during the fiscal year and estimates to spend on average $60 on repairs for each cart. 850 times 60. That gives us an estimated warranty expense of $51,000. Obviously, we want to keep track because that's money we're going to have to pay out. So that gives us that expense, and then we have an accrued warranty liability. So we are going to have to make sure, because we are going to have to come up with money to pay for it. That creates an obligation, and that's where that liability comes in. Okay. So once it says on January 16th, we paid to replace a defective battery, $125. Well, here's our liability. It says accrues its warranty costs and when it sells a golf cart. Because of this, no expense is recorded. Here's our part of our warranty here. And then it's going to come out in our cash. So it's getting rid of some of that liability. And excuse me, Emmy. So then it's going to come out in our cash. So we're still using that concept, matching revenue and expenses in that same period. So then it talks about accounting for warranty and uncollectible accounts expense. So it says, while accounts generally reverse an adjusting entry that creates a balance in a liability account, The accounting for uncollectible accounts and warranty expenses is an exception to the rule. So this one doesn't have to have a adjusting entry or a reversing entry in case there's a debit to the liability account. Okay, so I'm going to go over 8.1 and 8.2, and I'm going to create a separate video for that, and I'm going to put it into your guys's classroom, and then to help you guys out with your work togethers. Okay, so hopefully I'm going to stop sharing my screen here, and I will see you guys in class.